Today, we're diving into something super important for new investors, dollar cost averaging, or DCA for short. If you've ever wondered how to get started with investing without stressing about market timing, this is the video for you. Dollar cost averaging means you invest the same amount of money on a regular schedule, like weekly or monthly, no matter what the market is doing. Instead of trying to time the market and guessing when to buy low and sell high, you're building a habit of investing steadily over time. Let's break this down with a real-world example. Suppose you invest $100 every month into a stock or ETF. In month 1, the stock is $10. You buy 10 shares. In month 2, the stock drops to $5. You buy 20 shares. In month 3, the stock jumps to $20. You buy 5 shares. You've spent $300 and bought 35 shares. Your average cost per share is lower than the average market price over those months, which is $11.67. That's the magic of dollar cost averaging. You buy more when prices are low and less when prices are high. This strategy can help protect you from making big investing mistakes, like putting in a lump sum right before a market crash. It helps you stay calm and focused instead of reacting emotionally to market news. Dollar cost averaging is ideal for beginners who want to start small and grow over time, long-term investors focused on retirement, or building wealth slowly, busy people who don't want to monitor the market every day, reduces the risk of investing everything at the wrong time, builds consistent investing habits, helps take emotions out of your decisions, works well with automated investing tools. Let's talk about the mindset shift here. Instead of worrying about whether now is a good time to invest, you're committing to investing regularly, no matter what. That consistency is powerful. Most brokerages let you set up automatic transfers and investments. You can choose the amount, the frequency, and the fund or stock. And it just happens behind the scenes. There are a few things to keep in mind. Dollar cost averaging doesn't guarantee profits or protect against loss. In a market that consistently rises, investing a lump sum may outperform. Some brokerages may charge fees on small or frequent trades. That said, for most new investors, the benefits of DCA far outweigh the drawbacks. It gets you into the habit of paying yourself first, investing in your future, and avoiding the stress of trying to guess the market's next move. So that's dollar cost averaging in a nutshell, a smart, steady way to grow your wealth without the stress of timing the market. If this helped you understand DCA, share it with a friend who's just getting into investing. Until next time, happy investing.